Welcome, everybody, to the Kimberlite webinar that take a comprehensive look at the perforating and completion fluids market. My name is David Batt, President of Kimberlite Research, and I'm glad you can join us today. I'm accompanied by Andrew Thornton with Kimberlite Research, and together we'll take you through the 30-second Kimberlite webinar hosted on behalf of the oil and gas operators who've participated in our industry research. These webinars are provided as a professional courtesy and a thank you to the many oil and gas operators worldwide who participate in the Kimberlite industry studies. In past webinars, we've discussed the global drilling services market, and most recently, the hydraulic fracturing market. And prior to that, a comprehensive overview of the big four oil field service providers, SLB, Halliburton, Baker, and Weatherford. Let us know if you or one of your colleagues would like access to one of these prior webinars, and we'll provide those to you. Just send us an email or a chat message. Also, we often collaborate with oil and gas operators from around the world. We provide customized presentations to your organization. Just let us know. Today, we'll be taking a look at the perforating and completions market with updates on perforating guns, shaped charges, and we'll also provide an overview of the competitive landscape of how the service suppliers, both large and small, stack up in terms of performance, quality, service, and by geographies. Feel free to submit questions during the webinar, either through an email or chat box, and we'll be glad to address these questions during the presentation. For those of you that are less familiar with Kimberlite Research, I'll provide a brief background and then we'll dive in. Each year, Kimberlite conducts 3,000 one-on-one interviews around the world with users of oil field services. Some of you on the webinar today may have participated in one of our prior industry studies in the past, and for that, I say thank you. Our research is about 50% international and 50% North America. We've interviewed to date over 18,000 users of oil field services to provide a comprehensive overview of the market. We provide industry reports, talking to geologists, drill engineers, subsea completion and production engineers. Today, we'll be covering perforating and completion fluids, and we've been updating these industry reports every year since 2017. The trends we'll be sharing with you from 2017 through 2023 are based on interviews with over 2,500 users of these services and over 30,000 supplier performance ratings to provide the trends and analytics that we'll be sharing. The data set is rich and multidimensional. In this exhibit, we cross-plot supplier performance on the horizontal x-axis versus pricing competitiveness or pricing strategy on the y-axis. So I'll explain these four quadrants since we'll be using this value map, as we call it, quite a bit today. And then from there, we'll dive in. Based on customer reviews from oil and gas operators, any oil field service provider that plots in the top right-hand quadrant is viewed as a premium supplier, cost more but worth it. Bottom left, discount provider, performs below industry average, but has attractive pricing to where it's still in the fair value fairway and viewed as delivering good value. Effectively, get what you pay for. Bottom right, value advantaged. In any oil field service company provider that plots in the top left-hand quadrant, based on customer reviews, it exhibits some vulnerabilities and needs to either improve performance or maybe rethink their pricing strategy to become more aligned with fair value in the market. So with that, we'll go ahead and dive in. To kick things off, Andrew, there's been a lot of uncertainty in the market. Oil has gone over $90 a barrel. It feels more like 40 to some people. Rig count still a little bit tepid in U.S. land. We did pick up 9 last week, but what are you seeing out there and where we're heading with all this?
Yeah, thanks, David. So let's start with that $90 to $95 oil, depending on whereabouts in the world you are and what metric you want to use. This data is from the EIA, and it somewhat explains why we see this strong oil price. If we look at supply and demand, and this is global liquids supply versus global liquids demand in the line graph here, you can see how tight that's getting. Very, very tight. And actually, we're anticipated to be in a deficit really in the second half of this year, which we're in now, right? So as a result, that's why we're seeing oil price go higher, especially with those OPEC plus cuts really coming from Saudi Arabia and Russia. So that's driving the oil price higher. However, as you said, there's an expectation. It's kind of feels like 30, feels like 40. part of the reason is what we've just experienced. So in North America, US land specifically, we saw 2 years of growth close to 30% or over 30% in terms of overall activity. Whereas this year we're looking at 1% on a year-over-year basis.
Pretty flattish looking.
Pretty flattish looking. And so, when you've got used to this 29, 30%, you're suddenly, oh, wow, man, this feels like 30. That's not the case. It's just that growth is moderated, quite frankly. I also think it's important to note that, the expectations game. July of last year, the expectation for drilling in this year was to increase 15%. And then in December, it drops to 12%, then 6%, then 2%, and now we're at 1%. So although the market is steady or growing, the expectation has shifted.
Sure.
I think, though, on the rig count side of things, it's important to note there is a lag effect between oil price and activity. By and large, if you take a 6-week rolling average of oil price and project it forward 3 to 4 months, that's when you start to see that rig activity pick up. So we've been an upward swing here for a couple of months now.
Right.
So I fully anticipate that to start translating into activity in the fourth quarter of this year. And that's what we're projecting here. So we think we've hit bottom broadly in US. Last week, we saw rigs pick up. And then in the fourth quarter, although this is an average to average, really you're seeing this kind of bottoming out and then creeping back up again. And then the real activity increases begin probably March of next year. So a healthy market, it's not 30% growth, but that's not necessarily a bad thing, because 30% growth year after year after year is unsustainable and tends to lead to even bigger declines on the back end.
Sure.
An interesting thing to note, though, is why maybe rigs haven't picked up quite as aggressively is the fact that we're still producing not just a significant volume of oil, but actually almost record volume. So this is lower 48 states oil production versus lower 48 oil rigs. And you can see that they correlate very strongly, moving in the same direction. But then look what happens at the beginning of this year. The rig count starts to drop off and production keeps on going. Part of the reason for that is completion and drilling efficiency. So we've seen drilling days reduce. We've seen completion days reduced. We've seen lateral lengths continue to increase, stages per well increase, proppant per foot. That's kind of steady, slightly down, but overall we're seeing higher and higher intensity, efficiency, and that's why we're able to at least sustain somewhat the production relative to the rig count. In terms of what I think, or what we think, is going to happen over the next year or so, in terms of overall activity, it is still a healthy market. So US land drilling growth at about 3%. Canada, also relatively strong. Their market dynamics a little different here to the US. But then the real growth engines we're anticipating in 24 come internationally and in the offshore markets. Strong growth in the Middle East, strong growth in offshore areas such as Brazil and Guyana. We're going to lead some overall positivity. Now, this is a perforating webinar, so let's turn a little bit now to perforating and what we're anticipating. This looks at, very simply, do you anticipate perforating expenditure is going to increase, decrease, or stay the same year over year?
Right.
And an index is what we're looking at here. Anything over 50 equals growth. Anything below 50 would be decline. And you can see every region in the world is still anticipating perforating expenditure growth next year, led by international land and offshore. This is best visually represented, actually, when we look at this over time. So North America land, the green line, drives that growth through 2021 and 2022. And then this is deceleration. This isn't declining. This is just saying, hey, it's not growing at the same rate. Whereas offshore and international land, they're going to continue to grow strongly into next year. Often get asked this question when it comes to what's happening. What are you seeing? Well, what's pricing doing?
Yeah.
What's pricing? That's always a question a lot of people's.
Looks like it's rolling over here in North America land.
It's rolling over. There's anticipation of a slight decrease. Looking at 2% over the next 12 months. But again, look at that international land and offshore numbers. They're in still mid to high single-digit pricing increases. So
tightness in the market there, huh?
Exactly. And so that's something for service companies and operators to be aware of in terms of the international dynamic. We're playing in a global marketplace. And so this is going to be an important consideration.
Sure.
So that's kind of where I'm at from a global perspective, David. But turning to perforating, what are the questions, what are the operators asking for in terms of improvements in technology and services? And any updates on perforating guns and shape charges overall?
Sure. Each year since 2017, when we conduct these industry surveys and studies, we ask the oil and gas operators effectively the open-ended question, where would you like to see improvements? And so being an open-ended question, the operators are free to express their concerns and views fairly openly. We read through all of their commentary. And when you look at it on a globalized basis, I'm not too surprised to find that from the operator's perspective, looking for deeper penetrations, lower debris, and more consistent charge performance is really kind of the top of their concerns. But when we start to segment this out regionally, we see something in North America land, Andrew, that we really haven't seen since we've been updating this industry's study since 2017. You mentioned we're drilling longer laterals. And for the first time, we're seeing deep concerns about plug isolation improvements. And so that's an area for suppliers to really take note, and because the concerns of the operators in North America land have clearly shifted. We do see a little bit more interest in oriented perforating systems. You move internationally, and it's more traditional concerns of deeper penetration and lower debris charges, and very similar to that in the offshore environment. For the first time, I'll come back to that thought, but when we asked the oil and gas operators their preference for integrated gun systems, turning our attention here to guns and charges, you can see on the right-hand side of the chart here that the preference for use of integrated gun systems is climbed rather quickly from 2019, starting to flatten out now. But you still have about 41% of the North America land operators indicating that their use of integrated gun systems will continue to improve. We did ask for the very first time about any use of oriented perforating guns, and you can see that the North America land operators are citing use of this at a heavier level, but only about 1 in 5 planning to increase use. And when it comes to who really makes the decision what type of gun or shape charge to be used in the completion, you can see here that the oil companies in large measure really rely upon the perforating service company to make those decisions for them. Amongst the oil companies that do take a proactive position in selecting and recommending shape charges and guns, what we find is for shape charges, the operator's preferences for Hunting and Titan continue to grow, while we see some declines in preferences for Geodynamics, Owens, Core Lab, and DynaEnergetics. Internationally, SLB clearly is the brand preference of choice. When you look to perforating guns, again, we see that Hunting's preference is still climbing and very strong. We see Wellmatics, which is part of GR Energy, starting to show up. They're relatively new on the scene. Halliburton with Jet Research Center, JRC, they're beginning to prop up on the scene with their new technologies, where we're seeing some declines with DynaEnergetics. Owens Core Lab, relatively stable, along with Geodynamics, and again, offshore and internationally. SLB clearly has the brand leadership and the preference leadership amongst the oil and gas operators, followed by Halliburton in a distant second. When you take a look on the right-hand side of the screen here for Permian Basin, because we're drilling longer laterals, what we're finding is that the guns per stage are going up because we're using shorter guns and fewer shots per gun. But because the laterals are longer, the total number of guns being deployed per completion per well and the total number of shots are increasing as well. And the whole shape charge and integrated gun market has climbed about $1.4 billion, with the integrated gun systems comprising nearly 90% of that at 89%. And so that's kind of what we've been seeing as the big shift in the integrated gun systems really overtaking conventional systems. But, if we were to shift gears and as we think about the market and the brand image with respect to, just from an image perspective, how the major perforating suppliers are viewed in the eyes of the oil and gas operators, Maybe give us an update as to how they're viewed.
Yeah, absolutely. I thought it was really interesting there, just looking at some of those components, how we're pushing the envelope and how that's translating into the perforating market. So the question is like, who stacks up from that perspective? Who's can get that image across?
Right.
So if we look at Baker Hughes here, essentially what we're looking at is anything to the left of the 0% line would indicate image weakness relative to the market. It's not your brand perception. Anything to the right means that you're perceived beyond your customer base as being positive for that particular attribute. So when it comes to Baker Hughes, look, they're experiencing some what we call brand image deficits overall, relative to the market, but they have carved out a niche for themselves, being viewed as a lower cost supplier. Nothing wrong with that. If that's your brand image, that works very well for them. Halliburton, conversely, also seeing some brand image deficits across the board, being challenged in terms of its value proposition. So something for them to look at, which is a little bit of a surprise.
And they've been continuing to invest in their technologies. So maybe they need to turn the volume up on the work that they're doing.
Exactly. And this is, perception is reality, right? So you could have the best products in the world, the best people, but if it's not perceived that way, that can be a challenge. So they may just need to turn up the volume for that regard. Now, complete contrast here, this is SLB viewed very strongly across the board, well beyond their own customer base, quite frankly.
Very strong.
Technology leader, perforating modeling software, wireline perforating. They're viewed extremely well across the board. And critically for them, costs more, but worth it. So we talk about that brand image.
Right.
They're portraying that very, very clearly beyond their own client base.
Wow.
Weatherford looks a little similar to Baker Hughes, actually. Yes, there are some brand image deficits, but again, has created this niche for themselves as a lower cost provider in the marketplace.
Strong value.
Strong value. So, I mean, that's kind of how we see the images and all of those kind of components. But David, based on the most recent customer reviews, what observations are you seeing in the competitive landscape, taking that into account, and how is this going to impact our operator friends in finding best value?
Sure. And each year, as I mentioned, we interview the users for perforating services, and over the years we've interviewed well over 2,000 users and thousands of performance ratings. When we look at North America land first, what we find is when we ask the open-ended, unaided question to the operators, who do you use to perforate your well? And you look at the bottom right-hand part of this screen, you can see back in the 2020 industry study, 46 different suppliers were cited as being used. It's a very heavily served, highly fragmented market. And the market's been consolidating down to about 28 suppliers in the 23. So we are seeing some consolidation. In terms of just sheer market penetration, GR Energy, Liberty, Halliburton, and NexTier really tend to lead. So when you translate this into market share distributions based on the use of these various suppliers, really no perforating suppliers really garnishing a huge lion's share of the market. Is fairly highly fragmented, but led by GR, Liberty, Halliburton, NexTier. By contrast, when you move internationally, boom, you see Schlumberger. Their market share has been growing. They have 50% of the market. You see Halliburton's market share declining internationally. Now, it's very confusing because I'm sure all these suppliers are seeing growth in the market due to the growth that you mentioned internationally, as the international operators are investing at a very good pace right now to try to make up for lost time and underinvestment in prior years. But the distribution shifting to SLB's favor. And so you'll see this really benefit SLB as investment internationally continues to grow. Offshore, SLB still leads. When we ask the oil and gas operators to provide performance reviews on a scale of 1 to 10 on these 7 performance measures of the perforating suppliers: responsiveness to needs, equipment quality, reliability, competency of field service personnel, technical support, availability, operational advantages in the field, non-productive time and such, and pricing competitiveness, we see a really wide variance in performance. And so from an oil company's perspective, for oil and gas operators on the call today, on the webinar today, there's really no evidence to suggest that all these suppliers are performing at the same level. In fact, what we look at Kimberlite is we look at the trends, And obviously, you've got the industry averages here in the shaded bars, but you look for trends and you look for patterns. So if you take a look at responsiveness to needs here, you see Halliburton in red. They're improving year on year, but consistently, underperforming the industry standard. Whereas if you take a look here in this green color right here, this is Renegade. They typically get customer reviews that are better than industry average. And you also start to see this blue line, Liberty Energy, improving. By contrast, if you come to equipment quality and reliability, now you see a much sharper improvement by Halliburton with the new designs coming out. You see very sharp improvement with Liberty Energy. The point is, when you start to take a look at these customer reviews, particularly from the perspective of an oil and gas operator's perspective, it's very clear that each of these oil field service company suppliers have particular strengths and weaknesses. And for oil companies, in order to get the best value, we really encourage you to kind of collaborate with these suppliers and learn their strengths and weaknesses and see how that fits to your operational needs. Because when we translate this to the competitive landscape, and this is North America land, it's very clear that the value delivered is viewed differently. But and Liberty kind of stands out now as that premium supplier, having improved after picking up the OneStim assets. But there's a whole host of small to mid-tier providers encapsulated here as all others. If we open that up a bit, you begin to see all the choices that are available to the oil and gas operators that are really quite many. And if you start to break this up regionally, Permian Basin over to the left versus the Eagle Ford to the right, or the Bakken Rockies on the left and the Mid-Con to the right, you can see that not all of these suppliers are viewed as delivering the same level of value in each of these basins. They each have particular strengths and weaknesses. And again, it's really a call for the oil and gas operators to collaborate and invest some due diligence to learn the strengths and weaknesses of these suppliers to see where they can deliver the best value for their projects. Last week or month, we met on hydraulic fracturing, and we were looking at the completion efficiencies that you just spoke about earlier. And a big reason why the hydraulic fracturing service suppliers like to provide integrated perforating with their packages is because it adds to the synergies at the surface. And you can see that Liberty's wireline perforating unit has really improved performance since picking up the SLB OneStim assets a few years ago. And the value that they're delivering is pretty much aligned with their hydraulic fracturing. Halliburton's perforating performance is also improving and better aligning with their hydraulic fracturing. NexTier has always had pretty strong alignment between their wireline perforating unit and their hydraulic fracturing unit. They never were really that materially dislocated like Liberty and Halliburton were previously. ProPetro in hydraulic fracturing in the Permian Basin always performs really solidly in hydraulic fracturing. But the one area they've had customer reviews that are below the industry standard for 2 years in a row is with completion efficiency. And they've recently picked up Silvertip Completions, who's viewed as a value advantage supplier. And so we'll see how this impacts ProPetro's completion efficiencies moving forward to see if they can get back to the industry standard. And obviously ProFrac is missing from here because they're not involved
in that component.
In perforating, but they too have completion efficiency low ratings relative to the market that we highlighted last time we met for the hydraulic fracturing. So it'd be interesting to see if ProFrac steps in to the arena here for perforating. When we move internationally, we see clearly differentiated value. SLB as the premium supplier, Halliburton, Baker, Weatherford, all viewed as delivering strong value for the performance and for the price.
Nice, neat segmentation of the market there.
Beautifully differentiated. Actually, it's a great picture. This is the operators talking, basically saying, we see differentiated value. You can pay more, get more. You can pay less, get less. But depending upon the job and the application, maybe I don't need to have a premium provider. Maybe I could get by with a value-based provider. And so that's why really engaging in collaboration between the oil companies and the service providers is what drives ultimate value for both sides. When you move offshore, again, you see differentiated value. Just real quick, turning the tubing conveyed perforating, it's principally done internationally and offshore. Again, we see variance in performance. SLB is kind of a leader, both offshore as well as internationally. And again, we see differentiated performance, both internationally and offshore. But in the offshore, you see Halliburton's performance and value beginning to challenge SLB. But again, all the market participants are viewed as delivering fair value. And if you look at internationally, though, you also see Weatherford in a really advantageous position to maybe pick up some additional business as the international continues to grow moving forward. So I guess I'll stop here, Andrew, but I believe we just published the completion fluids report as well. So tell us what you're seeing there.
Yep, no, we have just published it just shy a week or two ago. So in terms of how things are looking, this is the Gulf of Mexico. Slightly different competitive landscape to what we would have been in some other markets. Obviously, Big Red, Halliburton, strong position there for their completion fluids business, delivering fair value. But Tetra Technologies really distinguishes themselves as a premium offering, a bit of a niche market for them. You see how small SLB and Baker Hughes are relative to the size of those other two. That translates obviously very much into market share, with Halliburton leading the way, followed very closely by Tetra, and shown some pretty decent growth over the last couple of years. Moving internationally, we flip the script a little bit and we get back to more of a traditional competitive landscape. But look how tight that is on the vertical in terms of performance. Everyone very tightly clustered there. The differentiation really sitting around approaches to overall pricing. Net, in terms of market share, it's SLB leading, but it's pretty close. Halliburton also a strong player. Baker Hughes also coming in with Newpark. Now, international offshore, we take a bet. We've got this vertical alignment here. International offshore, we're back more to a traditional kind of segmentation with pay more, get more, with SLB in the top right-hand corner, pay less, get less, Baker Hughes in the bottom left, all delivering fair value. So it's a segmented market depending on what the operators want to choose to go with, quite frankly. But then market share, again, SLB, Halliburton, really driving their overall performance for this.
Caught my eye in the Gulf of Mexico. Can you go back to that value map real quick?
Yep.
It looks like, Tetra and Halliburton, you'd almost think those roles are reversed in terms of their plot. Do you have any performance trends or anything to show on Tetra and the Gulf of Mexico?
Yep, absolutely. So let's have a quick look at that. Here we go. So Gulf of Mexico, Tetra. Again, if this is the average here at 8.2, you can see they're very strong and responsive to needs. Product quality sees a slight improvement year over year as well. Their personnel is bear in line, technical support, their availability, they're doing very strongly, quite frankly, across the board and exceeding the customer's expectation is what I would say.
Internationally and offshore, though, oftentimes drilling fluids and completion fluids are packaged together. Any insights as to how SLB and Halliburton stack up, since they're kind of the two big heavyweights, if you will?
Yeah, there we go. So international land and offshore, in terms of how they're packaged together, you can see here's SLB's completion fluids, SLB's drilling fluids, and then completion fluids and drilling fluids for Halliburton. A differentiation over there, Halliburton's value proposition being somewhat challenged. SLB with a little bit of a tighter clustering. But when we go to offshore, look how tight that is in terms of the value proposition from Halliburton. They're tied together with this dispersion here for SLB is one thing they want to take a look at, quite frankly, in terms of overall performance. Then, sorry.
That's fine. It looks like internationally, though, SLB's got a slight edge on Baroid.
I believe so. It absolutely does. So, let's see here. We've got a lot of slides we can blast through. I did want to touch on very quickly because we also published wellbore cleanup. And I know we're running a little short on time. So, wellbore cleanup tools, Halliburton, very strong in the Gulf of Mexico, followed quickly by Baker Hughes. International land, slightly different mix, much more competitive, quite frankly. If we look at this domination by two players here, splits into more of an even four-way battle in the international land market. SLB and Halliburton still lead. And then that was it. But one thing I want to bring you back to very quickly, consolidation in the marketplace. You mentioned something in our last webinar. We looked at the perforating and fracturing combining. Do you see any need for further consolidation in the marketplace, or is it something like we did just have the Patterson UTI, next year Altera deal come through recently?
That's true. Well, if you look at, I think hydraulic fracturing serves as a good example for the market. I know we touched on this at the hydraulic fracturing webinar last month, but back in 2016, hydraulic fracturing had many choices, highly fragmented. And then you fast forward to 23, we still have 20 different frac suppliers, so plenty of choices. But now the big four, Halliburton, Liberty, ProFrac, now next year with the acquisition and with Universal, they control 71% of the market. And so it's very clear to me that when we see this level of consolidation, particularly for markets where it requires scale and efficiency and investment in new next generation technology, that it's good to have customer choice. But if we get too fragmented with too many small suppliers, it's hard for them to scale. It's hard for them to invest in next gen technology. So I do expect to see more consolidation, both in hydraulic fracturing. ProPetro is still hanging out there. They did pick up Silvertip Completions, but you've got Calfrac, Step, and Trican, and a whole host of others. As I pointed out for perforating, there's still 20 plus suppliers for perforating services in North America land, and that's really a lot, because when you're trying to maintain efficiencies on the hydraulic fracturing side, and you've got a lot of different perforating suppliers showing up,
and you're pushing the envelope.
You're pushing the envelope. You need to have coordinated teams at the surface, and so I think you're going to see more integrated services. I think you'll see more consolidation to help drive investments and such. So that's kind of how I would do that. But I guess to wrap things up, Andrew, how do you see the rest of 23 stacking up for the industry, and any additional studies coming out here in the near term?
Yeah, absolutely. So, we've got various earnings coming up in the next 4 weeks or so. So we'll see how some of that international growth is translating into financials for the big service firms. Overall, in terms of activity, I mentioned it at the top. I think we're going to see a slight increase in the fourth quarter. So we really feel we're in the bottom from an activity perspective in North America. Do we have that traditional kind of slowdown after Thanksgiving? That's going to be a question. With $90 to $95 oil, there may be a few people who say we keep working through the Christmas holidays, so to speak. And then into next year, look, we see an improving market. It's quite clear the demand for oil is there. It's being demonstrated by the commodity prices. Demand for gas is there. So overall, rig counts above 700 in 2024. In terms of what we've got going on, next week, Thursday the 28th, we have the Artificial Lift and Production Chemicals webinar, which I'm excited about. And then in terms of reports we've got coming up towards the end of the year, formation evaluation, wireline logging, surface logging, cementing, as well hangers and surface wellheads. And then don't forget that once we've completed out this year, we'll roll up all of our reports for 2023, consolidate them together, and provide those large integrated service company reports in early 24.
Up in January, huh?
In January, yeah.
Very good.
Busy holidays for us as well.
Well, with that, I want to thank everyone for attending in today's webinar. I'd like to thank the many oil and gas operators globally who participate in our industry studies. Allows us to provide you these insights and trends that we see for the industry. Please feel free to reach out with any questions, and I hope you have a great rest of your week. Thanks for joining us today.